If the amount of spending increases by more than the amount of production, then prices by definition go up. And so there was a massive amount of giving away checks and money, and people seem surprised that they get inflation. Well, they're going to spend that, not going to increase very much in terms of the production. And so what is going to happen? The prices are going to go up when people spend more. And you put on top of that the issue of where we are geopolitically. We're changed the world in how resources are allocated. It used to be primarily that they were allocated on economic and profit basis. In other words, if some place was cheaper to produce something, then capital would go there, motivated by a profit, and it would produce it and raise living standards in those places. But it would move that profit, that production, from places that would have a hollowing out like the United States and so on. And we're now in an environment in which resources are allocated by political and ideological concerns or issues. In other words, we're not going to produce it wherever it's cheapest. And also because of worries that we might be in war, or that you could be in a war, every country wants self-sufficiency. And every country's worried, or every company is also worried, that they might be in a place where they are affected by politics. Think about it. The Nikes that you're buying, the Apples that you're buying, 22% of all manufactured goods imports come from China. And just imagine if the world said, we're against companies that are producing and operating in China, like Russia, let's say, if that was the case. That has an enormous economic effect. And companies today are considering, okay, where do I produce it? And it's not always produce it in the most cost-effective place. That adds to inflation too. And that's our new reality. Even like who gets the money in the system. In 2008, when they had the financial system, what the Federal Reserve did is it went in and it bought bonds. And when it buys bonds, it's buying bonds from those who sell bonds. And the bonds go up, and then those who are investors then take that money and they buy other financial assets. It does not trickle down to the population. It won't get the check to the person that needs to get the check. But in this last time, what they did is the government determined who's going to get the checks. So because the federal government can determine that, so the Federal Reserve buys the debt of that, but the checks go where it's directed. So the ideological and non-economic forces, in a sense, but those that are being managed for a greater purpose, get moved that way. And that's, by the way, also very typical of wars. In all countries, they become a command economy. In other words, if I just left it to the profit system and people buying what they want to buy, it's not going to get the resource allocation a country needs in war. And so you're seeing both of those dynamics taking place in producing inflation. So what does that mean? There's a paradigm shift. A paradigm shift is about a 1 in 10 year shift in the perception of what's likely and what the world is. There was a paradigm that was created by a combination of low inflation and also central banks producing free money. In other words, free money like almost zero interest rate or zero interest rates. That means you never have to pay. If you borrow the money, you don't have an interest payment. And that in many cases, you had interest-only loans and you didn't even have to pay back the principal practically. And also with low covenants, and the world recalibrated to that kind of an environment. A paradigm shift is when that changes. And so Americans thought, and many people, there was a 40-year bull market in bonds, and they think cash is safe and bonds are safe. That's what they bought it for, okay? And they did not realize, essentially, what they're now realizing. What they're realizing is that you can't judge safety in the number of dollars you have. You have to judge it in the amount of buying power you have. And so if you lose money to buying power because of inflation, you need a compensating return. So for example, with an 8% inflation and a near zero interest rate, you just lost 8% of your buying power, or almost that amount. So then that changes behaviors. People do not want to keep their money in there. I would not keep my money in there as long as interest rates are low in relationship to the inflation rate and the likely inflation rate. You're going to lose buying power. So that's why you see money moving. It's better to borrow than to lend, and moving out of that. What that does is it creates a difficulty for the Federal Reserve, because not only the amount of bonds that have to be sold are no longer the amount of the deficit, the trade, how many bonds do you have to sell? Well, it's the amount of our deficit. We have to sell bonds for that. And if there's other selling of bonds, then there has to be more and more selling. And then you have the Federal Reserve choosing to sell, that they're going to sell $1.1 trillion of bonds. So who's going to buy all these bonds? When you look at that, that means that there's a big tightening of credit. Now, everybody says we need to fight inflation. The way you fight inflation is taking away buying power from people. I mean, that's how you do it, right? You said, okay, now you're going to borrow less, there's going to be less liquidity and so on, at the time that there's more inflation. So it's not like fighting inflation is one of those things. We fight inflation and that's a good thing and we'll get on with it. It means taking away buying power. And that causes markets to go down, and that causes economies to go down. That's why we're in a period of stagflation. Central bank is going to try to find a middle ground, but there's a lot of debt, and somebody's got to be paid back, and you're either going to get paid back in real money, or you're going to get paid back in deflated money. And because they want to deal with both of those things and try to have a middle course, it'll produce stagflation. So what that means really is for investors is, in my opinion, don't hold money in those assets that have those kind of low returns. And then many of the bubble assets, always at the end of a paradigm, people who extrapolate what happened over the last 10 years, and they're sure it's going to happen going future, like tech stocks. I went through this many times, the Nifty 50 or the dot-com bubble and so on. That doesn't mean that technology companies won't do well or something. It's just like dot-com companies in terms of that, but there's a big crash in those things. A company, when it gets very expensive, it can still provide a terrible return. So we're going through that kind of a dynamic, which again emphasizes to me, have a balanced portfolio and with a skew toward inflation hedge assets, although there will be, in the near term, over the next probably year or maybe less, there'll be a tightening. That tightening causes the corrections and downward moves in most assets because cash becomes a problem. And so then you have that correction, and then you'll have the Federal Reserve come back in, I believe, and then print a lot of money and buy more, because that's going to be the problem. So we're in that part of the cycle. You could either maintain a balanced portfolio through that, in which case, if you're having something like the all-weather portfolio or something, which is or the all-seasons portfolio that you have, it's a type of time when you have the correction to maintain that type of balanced portfolio, because you're also seeing that the inflation hedge asset part of that portfolio does very well. And I think international diversification is also important. Now that becomes more complicated and get me into a longer answer than you probably have time for, but that's kind of it in a nutshell.